Hey everybody, it's Jeff. And in this video, I want to put out kind of an answer to this question. How did JP Morgan actually manipulate gold and silver prices? And are they still doing it today? My main job is trading the financial markets and the commodity markets. So honestly, I see this kind of stuff on a regular basis, but I know that this news event has kind of scared a lot of silver and gold stackers. And I want to kind of describe what exactly they did and whether or not they got punished for it. So this article's really kind of filtered out in late 2020. Or you see this article is printed around September 29th of 2020, but the actual manipulation happened between 2008 and 2016, at least from JP Morgan's side. And you can see they had to pay a pretty large fine, which of course simply goes into the CFTC's coffers. I always get really upset at these fines because they never make it back to the people. They just go into the government fund. But needless to say, JP Morgan, according to them, engaged in a pattern of manipulation in the precious metals markets. And this is what everybody's so upset about. The key is the traders would place orders on one side of the market, which they never intended to execute. And they wanted to do this to create a false impression of buyer sell interest that would raise or depress prices. And this is called spoofing. This is a practice that is used a lot in all markets. It's incredibly prevalent. The CFTC, to their credit, is doing the best they can to get rid of it in the commodity markets. However, it is still fully involved in the equity markets and stocks. This is a very common practice for most hedge funds. So let's describe what exactly is spoofing. I'm going to show you through an example. And let's just say this is the real market for gold. And traders will see what they call, this is a bid and ask ladder. Although what it really simply is you see the price of gold today is $1,832 an ounce. Well, the price of gold is simply the meeting of where a willing buyer and willing seller will agree on a price. And today it's 1832, and that changes every single day, both higher and lower. And what this says is at $1,832 an ounce, there are 10 contracts that are willing to be bought. At 1,831, a dollar less an ounce, suddenly 25 people would be willing to buy it there. 30 people might be willing to buy it at 1,830. And 25 contracts, 10, 12, you can see it's kind of an equal market on both sides. At 1832, you could see 25, 35, all the way up. But what JP Morgan would do is they would come in and they'd say, you know what? Let's place pretend orders that appear on the market. For example, you see the market on the left. If I want to come in and buy 100 contracts and I just said buy it at the market, it says buy whatever price you can. Those 100 contracts, 22 would get filled at 33. 35 of them would be filled at 34. I'd be going all the way up and I'd get my last of the 100 up at 1836. In other words, if I wanted to buy 100 contracts of gold, I would push the market myself all the way up to 1836. And what JP Morgan would do is they give the impression that there is a ton of offers, ton of contracts that are willing and ready to be sold above the market. Now, what this does, it doesn't create long-term price changes. It creates short-term price changes. It gives the appearance that in the near term, the market's probably going to go lower. And day traders will come in and say, holy smokes, look at this. At 1834 and above, there must be some huge whale that's trying to sell gold. I think the market's going to go lower. I can safely sell it at 1832 and know that if these offers still exist, then the worst case is I'll just buy it back at 1834. My risk is $2 an ounce, but if they're this ready and willing to sell, then the market must be going lower. So I give the impression that there is a ton of offers, but in reality, if the market started to move up, those would disappear. They created computer programs that said if we ever get close, then just pull it immediately before it ever get filled. So what they tried to do, and it actually was on both sides of the market, they weren't always pushing the market down. They would just push the market in the favor of wherever they're positioned at the time. So the key question, are they still manipulating the market? Now, at least in terms of JP Morgan, the answer is probably no. Whenever they get fined like this, the CFTC heightens their eye on JP Morgan. And at least according to JP Morgan, the conduct and the individuals are no longer with the firm. But as I mentioned, I mean, spoofing is a practice, unfortunately, that exists in all markets. CFTC has done a good job of trying to get rid of it in the commodity markets, and they do it through events like this where they put a massive fine on JP Morgan, and then any smaller fund that is spoofing as well sees that I don't want to have to pay nearly $1 billion. I can't afford that. So they're unlikely to do it in the commodity markets, although it's very prevalent in the equity market. So that's all I have. I appreciate you watching. Please make sure you hit the like button and subscribe. Take care.